Although options can be complex and may not be suitable for all investors, there are some basic option strategies that can be used more conservatively, some with the intentions of potentially enhancing portfolio returns. I'm Scott Connor, a 30-year veteran trader, and today you'll learn all about covered calls right here on Virtual Trade. Let's take a stock, Jenny, that's already in your paper money watch list, and then go through the process of what it would be like to actually put on a covered call strategy.
All right, great.
With the stock being just a little under 44, I'll highlight that. That would be this strike here. What if we went out to, let's say, 45? Now we looked at the chart, and we see 45 has been the highest level we've seen in the last 52 weeks.
Yes.
If we sell this call, Jenny, we would receive about 47 cents. Let's just say 50 cents. We'll round it up for that particular call. Now, what does that mean if we sell that one call? Well, we'd collect 50 cents. Remember, how much is that? 50 cents is really
$50.
$50, exactly. So it'd be $50 minus commission. Now, if we hit confirm and send, Jenny, it should confirm that. Yes, we'd get a credit of $50 minus our commission. Okay, great. So we've established now that we would receive a credit of $50 minus commission.
Right.
We still have our stock down here at 44.
This is pretty, I think, bold of us because the stock only hit 45 once this past year.
Right.
And it was a few months ago. It wasn't even recently.
Right. So what we have to do is let's consider the potential outcomes or what the stock might do between now and expiration in 42 days. If it stays where it is, okay, well, we don't make anything on the stock, but we just made $50 on the short call.
Okay.
Right?
So that's if we think that the stock is going to stay where it is or move a little bit, we are still holding that credit.
Yes, and we still have the credit. So when you sell the call, it's important to remember that credit comes into your account. So that $50 comes in minus commission, and that's in your account. That's yours, and it's already credited to your account. Now, if it goes above 45, whole different ball game. Now we have to worry about, okay, our stock could get called away from us,
right?
Because it's gone above our short strike, and now our obligation to sell the stock at $45 would most likely be we'd be assigned, and we would sell the stock.
So what will exactly happen then if the stock goes above 45?
Okay, well, on expiration day, the 45 call would be in the money, and it would be automatically assigned, which means we would automatically sell 100 shares at $45 a share. Now,
which
what
is
happens?
More than what we.
Yeah, well, it's $43.75 right now. So we would make $1.25 on the stock. We'd also make the 50 cents on the option. However, we would have no more stock and no more option.
So no more stock at all. Our 100 shares would be gone.
Exactly, and that's what we refer to as being called away.
Oh
right?
Gosh, so all this like the 100 shares we already bought would be just completely taken away.
Yep, it'd be taken away at a higher price. We'd get the $45 a share, so we'd make basically $1.25 on the stock, and we'd make 50 cents on the option. But you're absolutely right, Jenny. If we get called away, we have no more position in that stock.
So why would I do this then if I risk losing my position in Exelon, per se?
Well, okay, that's it. So let's consider the different outcomes. Now, the one we just talked about our stock getting called away and us having to sell it at 45 is only one possible outcome. The other one is, what if the stock stays where it is? Well, again, we don't make anything on the stock, but we made 50 cents on the option. What if the stock goes down $1? Oh, that's not good. So we lose $1 on our stock, but we still made 50 cents on the option. So that kind of counters some of the loss on the stock.
Okay.
So really, of the different things that can happen, up, sideways, or down, the only one we really have to worry about is if it goes above 45.
Above, even higher than we anticipated to go.
Exactly. All right, well, Jenny, you feel a little bit better about how the cover calls work?
I do, absolutely. This was a really good lesson. I think I learned a lot.
Right. So, all right, well, Jenny, we'll keep our eyes on this, and thanks a lot.
Thanks, Scott.
All right. So to recap, when a covered call is sold, the investor receives an options premium. If the stock price rises above the strike price, the short call is assigned, and the stock is called away. Now, if the stock remains below the strike price, the contract will most likely not be assigned. Now, in selling a covered call, you are agreeing to sell the stock at the strike price and, of course, miss out on any potential gains above that price. Now, let's see another way that covered calls can be utilized in a portfolio.
A covered call doesn't just bring in income on stock you own. Some investors buy stock and sell a covered call at the same time. This is called a buy right, and it can help lower the effective cost of purchasing the new stock. Let's look at an example. An investor is interested in a company that is trading at $100 per share. The investor decides to buy 100 shares for $10,000. If she writes a covered call at the same time, she'll earn a $500 premium, reducing the cost to $9,500 plus commissions and contract fees. Now suppose she was able to write a covered call every month and receive a similar premium amount each time, as long as the stock price stays below the strike price of the covered call. The premium she'd earn over time, less fees and commissions, would help make up for some of the cost of the stock. Of course, there is no guarantee that a covered call rider can consistently accomplish this month after month. Short options can be assigned at any time prior to expiration.